Hello, this is Brian Resney, President of Resney Wealth Management, bringing the important message and question and answer day. One of the questions that continuously comes up on my TV and radio show really is about which areas of the investment markets are really the most overvalued. And I've talked about this a number of times over the last few months. The bond market, in our opinion, is grossly overvalued. And what often happens is especially retirees and pre-retirees. Most Wall Street firms, I shouldn't even say most, I would say every one that I've ever seen. So let's go back to every one. Every bank, every Wall Street firm, every insurance company, they all do this age-based allocation, which makes zero sense. And all that basically means is they do these 60-40 portfolios or these 30-70 portfolios. So based upon your age, they oversaturate your portfolio with bond-type investments. Folks, there's times you don't want to own 30 or 40% of bonds in your portfolio. There's times you might want to have more cash or more defensive plays that are more defensive than bonds. There's times you want to have a little bit more bond exposure. But I will tell you this, over the next decade, those of you who have an oversaturation to bonds, and I would say more than 30%, even if you're conservative, if you have more than 30% invested in bonds, you are making a gigantic, huge mistake in your portfolio. You're taking maximum risk if you're doing that. Bonds go down in value when rates go up. But even if rates don't go up, rates are dirt cheap. You're talking 1.7 on the 10-year Treasury. That doesn't even keep up with inflation. So at the end of the day, are you better off with a total return portfolio that has some bonds in it, but you're getting a higher dividend stream than the bonds are paying, plus capital appreciation? Remember, risk is your money doing slight volatility over time that gives you the opportunity for a better overall total return, in our opinion. If you speculate, which you should never speculate, sure, your money can go down and you could lose money. But if you don't speculate, if you don't buy investments that are truly worthless that can go to zero, if you have a quality portfolio for a total return basis, your portfolio will hopefully slowly fluctuate over time, but provide the income and the growth that is necessary. Again, the vast majority of people that we talk to on my TV radio show or that are calling my firm now to hire us to manage their money properly are oversaturated in bonds. Bonds are not safe investments. They have volatility, they can lose money, bonds can default. When you ultimately don't make any money on your money, that's your biggest risk. Short-term fluctuation, in our opinion, is a natural part of the investment process. Your ultimate risk is oversaturating your portfolio in the lowest interest rate cycle we've ever been at in long-term or medium-term duration bond type investments. So you, the investor, that are working with the Wall Street firms, banks, and insurance companies, I can pretty much guarantee you're oversaturated not only in bonds, but the wrong type of bonds, the wrong duration of bonds, the wrong type of bonds. Make sure your portfolio is properly reviewed and don't fall prey to the herd mentality and the group thinking that pushes you based upon your age, which has nothing to do with risk, in the wrong allocation to fixed income versus equities or other alternative style investments. If you're not a client of Resney Wealth Management and you want to become a client, we do manage larger portfolios, 1 million and greater. Call our office for a consultation. We'd love to help properly manage your portfolio and keep you on track so your retirement can be exactly what you want it to be. Have yourself a safe and profitable day.